Good morning, everyone. Uh, Good morning, everyone. Happy to meet you on a Friday. Uh, you know, uh, Before we start the presentation, I wanted to just discuss about RSM in brief on what we are. Next slide. So at RSM, we have about 64,000 people worldwide, professionals with 820 offices in over 120 countries. We create, world-class technology and real-world experience to provide, deliverables across the world. We believe in, that we embrace challenges with adapt to thrive. Next. With more than 38 years of experience in Indonesia, we are amongst the bigger firms, and we're proud to say that we are the number five firm across Indonesia. We do our portfolio ranges from a number of services. When you see in the next slide, so we are present in almost all professional services related to accounting and advisory, auditing, business support, corporate activities, corporate finance, transaction advisory, government consulting, uh, governance and risk control, management consulting, especially on finance and performance related activities, tax. We have specialized teams into business tax, international tax, merger and acquisitions, transfer pricing. Then we have technology consulting. So that's a brief background about RSM in Indonesia and RSM worldwide. With this, I take the opportunity to start the presentation. Yeah. Jeremy, I can move to the next slides when it's done. My name is Salil Goel. Can you go to the next? I am a tax partner with RSM, and I head the transfer pricing and international tax division for RSM in Indonesia for over 3 years. Overall, I have 15 years of experience. I'm a chartered accountant and hold a bachelor's degree in commerce with advanced certifications in international tax and transfer pricing. My experience primarily, my core experience lies in price modeling, uh, value chain analysis and supply chain analysis, setting the prices, planning and dispute resolution for international tax clients related to transfer pricing and international tax advisory. Next, maybe you can move to the next webinar guide. Can you go to the previous one? Uh, Participant can submit the questions through the chat box on the screen. Questions can be delivered in Bahasa or English. Uh, our moderator, Jeremiah, do you want to come on screen and say hi? Yeah. Moderator will lead the Q&A session. Jeremiah is our assistant manager in transfer pricing practice. We expect the questions. Yeah. We expect the questions to be short, concise, and clear. And the webinar slides can be downloaded. The team will share a link, and if the feedback form will also be shared at the chat box at the end of the presentation or during the presentation. With this, can we go to the next? So the today's topics relate to the recent updates on the multilateral convention emanating from uh, you know the the presidential number 77 this year, uh, very recently, and I think we thought we will update on what it holds, and this will give us an opportunity to refresh on what multilateral instruments convention means for Indonesia. Then we will discuss on the OECD has released the final guidance early this year on the simplified and streamlined approach for borderline distribution and marketing activities for wholesale distributors largely. So We know that many Indonesian companies are into wholesale distribution, and this may impact on how the regulatory landscape revolves around it. We will discuss in elaborate detail on what it holds for us and our views in this regard. Then we plan to discuss on commodities pricing in particular. This is an area where we see continuing queries, some areas where we opine that the interpretation needs to improve, or further guidance needs to be provided on to the industry and to the tax office also on how do we deal with the commodity pricing and transfer pricing situations. It's not, Indonesia is facing challenges in relation to commodities transfer pricing. It's a challenge all across. If time permits, I'll also share some, insights on some of the developments taking place in other countries which are also commodity rich and have a lot of commodity exports, on how they are tackling with these kind of changes. Then we will discuss on the risks related to permanent establishments and financial transactions from the PMK 172 and how it fares with the earlier regulations, and you know what we need to be careful about when we design the transfer pricing for this year or next years. Then in the last, we will discuss on the some of the recent audit trends that we have seen, and what our takes are in this regard, and you know how we can mitigate those issues by active planning. Next. So we start. Next. So the multilateral instrument on tax treaty, I mean, this was already ratified by Indonesia initially in 2019, with the Section 2 or the Article 2 referring to the covered tax treaties to be 47. This also included Singapore and UAE in those 47 countries. So there is a new ratification, very, very recently, where they've expanded it to another 13 countries, so which technically makes it 58. But, depending on when the transactions happen, it could be, because there will be an interim period for 2019 to have the old treaties in place. So you can say that the number of covered countries now becomes 58. I'll stay a little more on this slide and discuss briefly on some of the provisions that impact. So this is the board counter of what multilateral instrument looks like and what are the articles. This is similar to the articles that are part of the OECD Model Convention and the double tax treaties. We don't intend to discuss in detail all the relevant articles, because otherwise it will take at least more than 2 hours to discuss these technically. We want to cover on specifically the new notifications that happened in recent times, and and on some of the key articles, so that we can take some takeaways from those pieces. Next slide. So the new added jurisdictions in the PR 63, Article 6 being a minimum standard that has been applied to all the relevant new territories that has been added. Article 7 has been Article 6 is a covered tax agreement. The purpose of a covered tax agreement, this dates back to some of the disputes regarding what is the purpose of a treaty. So this goes into changing the preamble and says that the purpose is not only to avoid double taxation but also to avoid double non-taxation. So this is what Article 6 covers. Not a very detailed implication, but more on the preamble side, just to give the taxing rights. Then we move to Article 7, which contains provisions about treaty abuse. So if you look at Singapore in particular, they have the all the provisions are applicable to Singapore in the new ratification, being a key member for Indonesia trade. So in Article 7, this largely uh, talks about the, the prevention of treaty abuse cases. Then that they should not be treaty shopping, and it covers provisions in this regard from the MLI. Article 8 talks about dividend transfer transactions. This is if you have seen, and when it comes to transactions related to dividend, there are structures that have been implemented in the past where an investment holding company is placed in between with minimal substance, or specially created entities are formed for the purpose of transferring dividend by using favorable treaty rates. uh, it has been the case with so many countries, and uh, Indonesia seems to have advocated for some provisions in this regard. Some of the uh, provisions that are suggested in this is applying a limitation of benefits clause and those conditions, just to ensure that there is active substance of the shareholding that a particular entity has in the other country, and it is not for the purpose of stripping the income by just purchasing the shares sometime back, taking the dividend, and then you know selling it again. So there has to be substance on and the beneficial ownership application when it comes to evaluating the uh, dividend transfer transactions. So if you see that these provisions have been added to the four treaties, then Article 9 on the capital gains have been added. Uh, then Article 12, again, this is not a minimum standard, but that has been applied to all the new countries that Indonesia has ratified. Because I think, technically speaking, commissioner arrangements are something, maybe just explaining what commissioner arrangements are. This is acting on behalf of the principal. When you may not have a legal presence, but you can just act on behalf of another person. Many countries do not have legal status, or do not, or prohibit commissioner arrangements. This includes India also. But I think in Indonesia there is no specific restriction on the commissioner arrangement. So this, by way of coming out with artificial avoidance through commissioner arrangements, this is the step in the direction that you know if you are having commissioner arrangement, it should not lead to erosion of taxes. So this is an important provision. Then there is the article on permanent establishment through specific activity exemptions. So in this article at MLI, there are two options provided, where Indonesia has opted for option A, which provides that if your activities, certain activities of business and auxiliary nature are to be, seen in a more detailed perspective, and only if you are typically qualifying the tests of a business and auxiliary activity, then you can, apply, then you can avoid a permanent establishment. But there are more details, which emanates from the global guidance, that whether this applies to, transactions uh, involving e-commerce and others. Still, there is not a lot of guidance on how Indonesia, sees this. Not a lot of judicial precedence also has been in this regard. So it will remain a tricky area on how this Article 13 option A, which Indonesia has utilized, is going to work in practice. Mutual agreement procedure. Indonesia has reserved its rights to settle the mutual agreement procedures not by mandatory arbitration, but by way of the contracting, by the mutual agreement between the contracting states of Indonesia and the other country, which is party to the treaty, to resolve the tax disputes. Indonesia is already trying to make significant progress in this regard by reducing the map settlement times. So I think this is similar to what India and many other countries in the developing states are doing. Uh, Corresponding adjustments. This again provides for the fact that if you, if based on the application of a treaty, let's say, if the income is attributable to the source state, then the resident state should allow the uh, allow the credit of taxes paid in the source state. This is usually present in Article 9.2 or 9.3 of the treaties. Indonesia has not provided any specific application because Indonesia already has this in most of their tax treaties, and they have just not made specific reservations and just added that provisions of those articles in the treaties already cover this and should be sufficient enough. So this is a very brief introduction on the MLI convention and on the updates to the MLI convention from the PR 68. Next. So I think this is just the list of 47 countries initially, and then 48 to 60 represents the new countries. This is coming in the coming in Article 2 of the MLI. Uh, you could see, I think there is a copy available at the website of the tax office, and also English copy is also available in case you want to see. Next. So then we move on to this hot topic on the streamlined and simplified approach for baseline distribution activities. I'll take a moment and step back on the OECD's Pillar 2 solution in this regard. The OECD's two-pillar solution process started in 2015 when they addressed the issues related to digital economy and there was a lot of tussle between developing and developed countries on who should get the revenues uh, in relation to the activities which are not done through the brick and mortar model, where you don't know where you don't need to specifically, like earlier, open offices, create registrations to do business in the country. You would know countries like Uber, countries like Netflix. They may not need to. They're operated by a server and may not need specific presence in each country to operate their business model. So, initially all these countries, contained the tax revenues in their host country because of the fact that the traditional international tax rules did not apply. That they did not open a fixed place of business in the other country. They did not had people visiting and staying in the other country for more than a number of days, and those kind of things were there, and but they were contributing to a sizable business. So that's when this pillar two solution was evolved. So what it addresses the in 2015 action one was to address the uh, web section one, try to address the challenges of the digital economy. In 2019 the proposal of a two pillar solution model came in. Pillar one talks about the activities related to the you know uh, basically to digital activities and also related to distribution activities. And pillar two talks about the minimum tax that a country needs to have. So in 2021, so this is the basically a landscape of how this regime operated. In 2021, global consensus was achieved, and you would have seen many countries started to implement that into practice. Some of the countries use the option of having a digital service levy or equalization levy or various ways to tackle the digital services. In 2022, public consultation on amount A and B of Pillar 2 model rules were released. And then 2023 talked about two guidances were released. And then in 2024, Pillar 1 amount B SSA was released. So Pillar 1 amount B SSA, which talks about simplified and uh, this does not typically restrict to the digital activities, but applies to all all activities. Uh, then this is expected to be live from 2025. I think the pardon for the the arrows should go in a different direction, but that's how the rules are. To the next slide. So, what does the OECD two-pillar solution contain? Broadly, the pillar one talks about amount A, B, and C. Amount A uh, you know, has been focused earlier, which reallocates. These provisions I'm talking from the OECD guidance that it reallocated profits over 10% to the market jurisdictions because there was a lot of growing for some even examples came out that like the Louis Vuitton, let's say for example, a branded company, uh, established brand was based, was from Europe, but the majority of the customers were in China. So China started to profess that it is because of our customers, our customer base that it contributes to income for Louis Vuitton in China. So then the furor started about market jurisdictions should be the way to tax these kind of transactions. So you know this is one of the examples where the traditional opportunities were changed. And there are a lot of case laws in this regard, but I just wanted to give you with an example so that you can relate better that you may be operating as headquarter from one country, but you may not have significant customer base in that country. This was not tested earlier, but over the last few decades, this has become a big issue, and now you know with the UN also professing for it, for taxing rights to be provided to the source country, and then these OECD two-pillar solutions come up with some kind of a negotiation so that the developing world will agree. We still, US is still an aberrant to these provisions, likely because of their domination on the digital companies in this regard. So what does amount A says? It says that if your revenues are sizable and then you should attribute at least 10% of your profits to the market jurisdictions. So if you are earning heavy profit, from your sales and your revenues in a particular country are sizable, then these are the tests that has been applied to safeguard, because otherwise the companies would be at a significant burden that if they are operating in 100 plus countries, then they need to allocate the taxing rights in other ways. So they come up with the substance threshold that you need to have revenues of at least 20 billion euro and a profit of at least 10% in your 20 billion in that country, and overall profit in the business of this, then you should allocate to market countries. Then amount B comes up with a formulaic approach to reward baseline distribution activities. It potentially cover all entities. As I said, it is not limited to digital activities. And then amount C, this application is still to be confirmed. It remunerates local activities and provides dispute resolution mechanism. Pillar 2 will not talk about it, but the purpose of Pillar 2 is to provide a minimum taxing right. And it says that if, you know, this is more, as I mentioned, about the Article 2, where, you know, if one country does not tax, let's say they don't have, you have you have a transaction between a source and residence country. Previous rules mentioned that, if the source country is the one who should be taxing the income. If they don't tax, then the Pillar 2 comes up with some kind of mechanisms where, various provisions like income inclusion rules, top-up tax, and other provisions are provided, where if you don't tax, then the other country may have a right to tax. So there will be a preference, and there will be a backup mechanism ensured to see that, um, you know the there is no double non-taxation. Next. So in order to apply the simplified, streamlined approach, baseline distribution activities, the first condition is that it should be baseline distribution activities. What are baseline distribution activities? It should be core distribution functions. It should be, purchase. It should be like a buy sell arrangement. You buy from related entities and sell to third parties, and not do retail. You are not selling to the third customers or the final customers. Your activities are routine, uh, you know, appropriate for one-sided transfer pricing. But mind you, while the while your transfer pricing is one-sided, transfer pricing itself is two-sided. So it will impact the other side on the application of these rules. And unique and intangibles are excluded from this exercise, because this is supposed to cover, volume businesses which are doing, routine functions, wholesale, no customer branding. Marketing might be there, but they have put a cap on that. If those conditions are met, then they have provided a kind of a safe harbor or simplified regime where you may not go through a complex transfer pricing documentation and benchmarking exercise, and may, uh, you know, uh, refer to the guidelines and, attribute your profits to a minimum rate. Quantitative filters, the quantitative filters referred for the distribution activities is that you should have the ratio of operating expenses to sales not exceeding 3%. This is because if your operating expenses are your, expenses below the gross profit, which in transfer pricing terms is towards, uh, you know uh, which could go towards sales promotion, it could go towards, value addition or value creation activities. So by these provisions, they are trying to limit the value creation. So it says that it should not be lower than 3%. There should be some value addition, but it should not exceed 20 to 30%. So that's the capping that they have provided, right? Because the I think the logic to this is that if it is lower than 3%, then likely have you may not refer to it, because uh, these guidelines come with the minimum profit. But if you're not spending anything, then it does not make a difference. So some of the exclusions are, as we said, that, retail sales are excluded, services are excluded, digital sales are excluded, and commodities are excluded. So I mean, because I think the OECD's discussion on commodity is a very sensitive area, because I think it's to do with the natural resources in many countries. So I think the OECD does not want to touch, even if that relates to wholesale distribution of that activity. Uh, so this is something that has been excluded, likely knowingly, by OECD. Next. So these are the kind of industry groupings that has been provided. Um, the first one relates to the perishable goods, perishable foods, grocery, household consumables, construction materials and supplies, plumbing supplies and metal. Group 2 relates to IT, hardware, vehicles, pharmaceuticals. This is done based on some statistical analysis by OECD, by referring to the past charts of, how the kind of distribution activity is undertaken in these companies across the world, and what are the margins that they use. So this is based on a statistical approach that they have divided the group into one, two, three. One being the lowest and three being the highest in terms of the extent of distribution value in the overall supply and value chain. Yeah, next. Then it talks about fact they in order to you should apply some intensity intensity ratios to understand that the numbers are making some logic. So uh, the the two ratios that are used is net operating asset intensity, which is net operating assets as a ratio, divided by net revenue, and operating expense intensity. This is again to ensure that you are doing borderline activities. If your operating expenses are too much, that means that that you may be contributing significantly towards building a marketing brand for the company. And same, the operating assets also, for a routine wholesale distributor may not be significant. So I think these are the cappings that they have added. Next. And this is very, I mean, the previous ratios that they have used is very logical to even the routine transfer pricing that we do. We also use some ratios in order to, in our benchmarking comparables to eliminate some companies who are, having significant exposure to assets or who are doing significant value addition. So I think it makes logic in that sense. So overall, the numbers vary from 1.5 to 5.5%, in relation to the grouping of activities. So the groupings are done based on the level of operating asset intensity and the operating expenses intensity as a ratio of sales. So based on the various high, medium, low categories, the ratios are coming out. We will discuss this with an example to make sense. Then if you look at, there is a margin of error provided of plus minus 5%, which we call it as tolerance range. That if your numbers are around plus or minus 5%, then uh, this should also be acceptable. So basically, this is kind of a benchmark, or I would say headline rate, that the guidelines seem to suggest that if your activities are pertaining to group one, like perishable foods. To take an example, if you're doing perishable foods and then you are having a high operating assets intensity, and then they expect that for that level of distribution, you may have a 3.5% distribution margin, or let's say 3 to 4% if we take into account the margin of error. So if your actual results are between 3 to 4%, then you can say that instead of applying the distribution benchmarking, I can refer to these rules, provided the Indonesia applies these rules, in next year. As of now, there is no I'm assuming that Indonesia, the DGT must be reviewing on how they want to, use these rules into practice, because it is part of the qualifying countries. So Indonesia should say something about it, likely to adopt. And given that Indonesia is also trying to become OECD nation, so likely that there might be some favorable response in this regard. Uh, and in practice, we find that a lot of, even in all industries across, we are handling clients which are in grouping one, two, three, all, and you know, doing wholesale distribution. So there is a adequate application to Indonesia, and they may want to uh, ease the issues related to transfer pricing related to these areas. And this will serve even if they don't adopt. This may still have some persuasive reference, because it's based on a statistical measure. So based on the different level of your operating assets and operating expenses intensity and your industry classification, OECD provides that if your numbers range between these headline rates with plus minus 5%, then this should be acceptable. But they also provide, maybe go to the next slide, Jeremiah. They also provide that this is based on the likely this is based on a investment rating. So if your country has lower sovereign rating, then they say that then the level of markup that these countries would need, considering their developing status and the strength of the currency and the inflation rates, this may not typically apply in the same way. So they also provide for a sovereign credit rating adjustment in those cases. So just to give it with an example, let's say we talk about a company who belongs to Group 1. Let's say it deals in wholesale distribution of perishable goods. And they have this financial metrics. They have a sovereign. We assume that the distributor is in Indonesia, and the sovereign credit rating is double P plus. We know that the sovereign credit rating of Indonesia has improved over the year, but to but we have deliberately used the previous sovereign rating just to provide that in case you have an outbound transaction where Indonesia is getting wholesale distribution done from other countries, then there could be a sovereign credit rating impact also. So just to create that example complete, we are using that as a mechanism. So in this situation, we say that, let's say, based on your turnover and gross profitability coupled with the operating expenses, your return on sales, which is operating profit divided by turnover, is 2.2% in 2023. And, likewise in 2022, 3.2, 8.6, and 2.33. And this is your, operating assets. What the regulation requires is that you need to use the weighted average of the last 3 years in relation to operating assets and operating expenses to compute the intensities. Go to the next slide. So it says that if in order to apply the pricing metrics, you should, we computed the return on sales being 2.22, and if you look at the grouping chart, can you go to the grouping chart, industry classification chart? It says that, and in the example that we have used, the operating assets intensity is 42%. So operating assets as a ratio of sales is 42%. So based on that, the group is 1 and go down. Then, being 32, 44%, the industry grouping requires that the range should be 3% plus minus 0.5%. Now go down. But in the actual results, go to the previous, in the actual results, the return on sales in 2023 happens to be 2.22%, so which falls outside the range. So as per the guidelines, if you don't want to do a transfer pricing benchmarking and want to rely on this, then you can do a voluntary adjustment of the numbers and bring it to 3%. Now this 3% is the minimum number. 3% is the average number, median number used, so to say, that plus minus 5 is just the cover. So if you want to use the real number, that will be 3%. So based on that, the regulation says that you need to make adjustment to the COGS. So in this example, you will have to make adjustment to this 2.4 billion and make an adjustment of 11 million, 2.4 trillion and make an adjustment of 11 billion. So that is the outcome, if these guidelines are to be accepted in the transfer pricing analysis. But so this what it does is it will provide with a target return of 3%. And if that is what Indonesian tax office regulates, then that should be it. And no further adjustment needs to be done if you follow the simplified and streamlined approach. But then we will go to the next section. But in order to apply this, it has to be applied consistently. It cannot be that I apply in 1 year and don't apply in the other year. So there has to be some consistency, which we'll talk later. It also provides that you need to like I mentioned that 3% is the rate if you have an investment credit rating which does not require any modification. But let's say Indonesia is BB plus and requires an adjustment of 0.7%. So 0.7% adjustment also needs to be done on this transaction. So the revised ROS will not be 3%, it will be 3.29%. Like I mentioned, based on the sovereign credit rating, taking into account the local conditions in Indonesia related to inflation and others, which require an adjusted rating. So based on that, the return on sales will be about 3.29%. Next. So where it leads us, as I said, you have to apply, if you want to follow a SSA approach, as per the guidelines, you should be Yeah, apologies. I think I had a system breakout. Yeah. So there are some qualifying criteria which we already discussed. Some of the key issues that that still needs attention is the treatment of foreign exchange, because I think whether it will be considered as operating or non-operating, it is still a challenge that we face uh, you know in existing in existing disputes with the tax office, because and whether depending on that the ratios will change. And then this is something that requires customs duty evaluation also, because let's say, because it works like a year-end adjustment. So if you let's say make, in our example, you made a return of 2.22% and you want to make it, let's say, 3.29%, which means that at the end of the year you will have to make a say you will have to make an adjustment to COGS, which is your your intercompany purchases from foreign country. So besides foreign exchange, there will be customs duty implication. Your customs duty you might have already paid at a higher or lower value. Then accordingly, while I think the uh, while I think that you can still revise your customs if you have a higher duty to pay. But what if you you want to take a custom, what if it results in a higher duty payment, and can you adjust that? So these are some things that needs to be fixed. So it will not solely be uh, an issue which relates to income tax, but it may also have implications from a custom side, that how the customs are going to evaluate this. Next. So indeed, is SSA a benefit? Given that Indonesia has, because it works like a optional safe harbor, but OECD has already released a safe harbor in relation to low value added services, where Indonesia has not adopted as such. So whether they will, because I think the although the parameters are different, but are they going to apply this kind of a safe harbor for wholesale distributor? I think may or may not be, because as I said, uh, the risk is higher in case of services uh, because of no movement of goods. But here the movement is there, but still there remains some apprehensions whether safe harbor will be accepted by Indonesia. Do we have a clear understanding? Because this may also involve your because streamlining also comes with creating segmentations. So if you have a wholesale distributor activity along with other activities, you may need to properly segment the transactions. Then whether your year-end adjustments will be how your year-end adjustments will be taken into account. These things are something that will be a key concern on the application of SSA in practice. Jeremy, can you hear me? I see that there are some issues.
Yeah,
Okay,
your voice is clear.
okay. Next. So these are things that I think I will not cover it again in the interest of time. That you also have to look at the regulations from the head office side also. That if you apply a say kind of a if whether the head office also adopts uh, this provision of OECD, uh, or head office, or any country where you are doing trade with or purchasing from. Because if Indonesia accepts, the other country does not accept, and they have a different margin, then this will create internal inconsistency in relation to the distribution activity. This goes back to the fact that the wholesale distribution activity benchmarking is a one-sided transfer pricing approach, but transfer pricing itself is always two-sided. It impacts the other party. And the characterization of distribution activities, whether it meets the borderline distribution activity, it meets the ratios, it does not create brand. Approach in each jurisdiction, as I mentioned, whether you have the ability to segment in case needed for the purpose of wholesale distribution activity. And given that if you may be involved in other transactions, because it does not apply that if your main activity is wholesale distribution activity, it only applies to the extent your entire activity is wholesale distribution activity. And in case you have more, other than wholesale distribution activity, then you need to create a segment for this. So this is again going to be a tricky situation. Uh, then you have to do the impact assessments and stakeholder engagement on how well in time, in parallel with when Indonesia is trying to implement these regulations. So this is it on the topic of simplified and streamlined approach for borderline distributors. I hope this will give some understanding. It's a very it's a detailed topic, but I tried to give you some sense of which way the OECD is thinking to reduce issues uh, related to this issue. But I am sensing that it may not be as straightforward. Maybe the the disputes related to benchmarking might go away by adopting this, but then with the other challenges, disputes will come on other areas, especially like characterization or the treatment of certain items like forex, customs, and other things. So I don't know. I mean, time will tell how effective this will be, but a lot of customs lightening is required to make it a success. Next, now we move to the topic on commodities pricing. Again, it's an area where we find in daily practice uh, lot of different interpretations. Uh, you know, then the lot of interpretation issues in this regard. So what we have tried to do is we have tried to provide our estimation of how do we see some of the relevant provisions in this regard, how other countries are tackling this kind of an issue, and then maybe some takeaways that you can if you are dealing in if you are a commodities trader or dealing in commodities, then what you should keep in mind and how you can prepare your transfer pricing policies in this regard. Next. So I think this dates back to the issue that um, that most of the countries are trying to benchmark commodities plainly by referring to the cup method and by a cup method or a quotation method by referring to the commodity exchange prices. But in reality, while OECD also, makes references that, wherever applicable, you should refer to the market data, if it is a factor. But if you look at, the point C in this slide, point B is what, I think is understood well, that quoted commodity price is a commodity market price obtained from domestic and international commodity exchanges, which you might be doing with independent parties and which you might also doing with related entities, and that can be used as a fair market practice. I believe some businesses use that, but it is not, or maybe even within a business, you may have certain trades based on index pricing, but in certain cases, you may have different factors to enter into business dealings, and that's where this point number C on paragraph 2.20 of the OECD 2022 guidelines becomes relevant. It also requires that you need to make adjustments that are economic, so that the economically relevant characteristics of the transaction are comparable. And some of the examples they have provided is the physical features and quality of the commodity, contractual terms of the transaction, volumes traded, period of arrangements, timing and timing of delivery, transportation, insurance, and other foreign currency items. So the things will be very different when you are doing this commodity transaction between with domestic players compared to your international suppliers or sorry customers, and you have to make appropriate adjustments. And in practice also we dealt with a case where the reference was made to the index prices, and even uh, within that year, because that was just the start of business for that entity, and they were doing certain transactions. They were using industry reports or the index prices, based on international bulletins, but they were making adjustments, relevant adjustments to account for the transportation, insurance, bulk or volume discounts, and these are very in practice uh, difficult to obtain data or make comparable adjustments or comparability adjustments in that regard. So whether cup in those situations will apply squarely in the absence of that data is a $1 million question, but I don't think that it is understood in that sense by, you know, by all stakeholders, whether it is DGT or whether it is industry professionals. So I think this implication is very important. And I'll just cover this, and I'll also share some interesting insights from other countries which could help understand this topic in a more detail. So your contribution, how the transactions with other parties affect the supply chain, value chain, all these things needs to be considered in pricing your commodities. So it's not a factor of what the government regulations are around this topic or what your index prices say. If they are used actually in your contracts or arrangements with your customers, then, whether it is third party or related party, then to evaluate it that way. But if it is not, then you may have to, be open-ended about analyzing the transfer pricing for those transactions. And this also, besides commodity, it is applied to general transfer pricing also, which states that you have to delineate the transactions, refer to the agreement, because this is the starting base, right? That you have to look at the conduct of the parties, arrangement between the parties, factual and legal agreements on how they do the transactions, and then you should be picking the base from there. But so, whether the prices notified by government should be used for transfer pricing as it is, most likely our response seems to be no. But we are also further evaluating on, to create a more elaborate position on this. But we thought we discuss some of the, developments in this regard. Next slide. Before we go to the Indonesian side of things, but I also wanted to highlight that, let's say, countries like the advent of commodity prices with reference to the quotations or index prices. This started way back in Argentina. I think Argentina was the first country that started to apply, quoted prices to benchmark commodity transactions, and then followed by other countries. Because it all depends on which countries have access to those kind of commodities, which play a very important role in their export scenario. And so the provisions from Argentina, and in fact, Brazil is also very interesting in this regard. Brazil has been following a safe harbor for transfer pricing for most of the transactions, but very recently they have also recognized that that you may also need to refer to the other methods for commodity transactions. So previously, Brazil also applied the quotations blindly, irrespective of the adjustments. But now they understand that depending on the nature of transaction, it's not only cup. If the if resale price method is appropriate, where let's say you are a commodity trader, and the trader is using the market price and the who bears the market risk, and what kind of activities are performed by the manufacturer or distributor, and if that helps in determining the correct tested party and the margins, then resale price method can also be accepted for a commodity trader. Then the other cost plus method may also be acceptable. Let's say, if your activity is classified as a contract manufacturer, and then depending on the other circumstances that it is for captive consumption, it may also be a relevant method depending on the facts and circumstances. But often in practice, because of the lack of data or characterization at gross profit and net profit for the comparable companies, this method is not used in practice. But the Brazil also recognizes that this could also be a potentially comparable method. Same goes with the transaction net margin method and other methods. So it is not something that cup should be used as a default method. And in fact, we have referred to the guidelines in Indonesia also, where it says that for commodity transactions, yes, there is a reference to cup method, but it also says it uses some language like, I'm referring to PMK 172, para 912, which states that if methods referred to in para 1, you know, basically I'm referring to the commodity transactions and other methods, then the cup method should be given a preference, provided it is equally reliable. But like I mentioned, in practice, maybe equivalent reliability may not be existing, and then whether you want to apply the cup method is always a factual scenario, and it should not be used as a means of thumb. We are also studying further on these issues, but I thought it is important to reflect on some of the upcoming guidances in this regard, what Indonesia has in their regulations, what other countries are thinking. And like Brazil was a classic example, which is also moving from using safe harbors or quoted prices or cups to also being open to other methods in the light of developments. And one other thing is, there was an interesting article that I was reading, which mentioned that the advent of commodity trade trade pricing was started with mispricing. Mispricing was exploited by countries to uh, to beneficially make use of tax provisions in one country and take away the natural resources of the other country. And that's where uh, where you have low. It was primarily to suit the low income countries with inadequate infrastructure or tax administration to or the lack of tools and sophistication to counter these kind of transactions. They started with those countries that you should form a rule based approach and you should have your government regulate the prices for transfer pricing. While that's where we are of the opinion that maybe it is safeguarding the through a sales price is more in the interest of uh, uh, you know capping the income, because I think income tax works differently from transfer pricing. If you look at the definitions, can you go to the next slide? Can you go to the next slide? The definition of transfer pricing and income tax is also different. Like, maybe the regulations where they determine the government regulations to be followed for fixing a sales price, that is towards determining the income, because sales is because it only talks about sales, which is to determine the income, which is subject to an income tax. But in transfer pricing, it does not talk about specifically related to income. It talks about any transactions which are influenced by a special relationship, which have a direct income, which has bearing to income or may not have a direct bearing to the income. So these are some thoughts we want you to leave with you, that the government regulations may not necessarily be a transfer price or a price that you may use or necessarily use for doing your intercompany transactions. Back to the slide, Jeremy. And in fact, at RSM, we also contested one case, although it was related to pre the regulations for, let's say, coal prices, where the minimum the HPB prices regulations were introduced, which mentioned that you should use a lower you should be using the higher between the lower between the HPB price or the actual transaction price at the time of transaction should be the one that you should be using for your income tax purposes. But for transfer pricing, it may not be true, because as I mentioned, if you have a transaction related to export, then you know you need to look at, or when you have a transaction with related entity, then it may be influenced by special factors. There may be a financial independence, financial support provided, various other kinds of blending might be available, purchase support, let's say financial support, so many other kinds of factors which will be required to be evaluated. You know, the volume discounts, the various other assurances, pricing guarantees, all these things need to be evaluated to determine the transfer pricing. Next, I think we are running short on time, but I think we covered what we intended to cover. So next is I wanted to update on the Article 15, which refers to the PMK 172 regulation on the permanent establishment. It has come up with an interesting insight that Ps may be required to submit the data related to transactions and how it fares to the existing provisions um, in the Indonesian tax regulations. Let's say oftentimes we find you know clients inquiring about deemed if I have a deemed I have if I'm opted for special norms and I'm paying taxes based on deemed taxable income. Is it subject to transfer pricing? Am I still subject to transfer pricing? Likely the answer is yes, because as I mentioned, that income tax and transfer pricing may have different purposes, or the factors are quite different. And while it provides you assurance that your corporate tax uh, certainty is in intact, but you may still need to provide transfer pricing reports, just like same as coal. Like for example, if I have to just synchronize the provisions of government regulations with the actual scenario, the tax officer may still have an incentive to say that, while the company is necessarily bound to follow the government regulation to fix its sales price, but in reality the sales price be even more maybe even more, depending on where they are selling to, and you know and what are the additional activities or services provided by the company. So accordingly, the tax officer may have incentive to overestimate the income, and in order to avoid cases where your activity is considered to be higher than what it needs to be. And I think all the for all these reasons, I think transfer pricing is still a very relevant exercise to safeguard the interests, because it does not correlate to the transfer pricing requirements. If you have a transaction, it does not say that if you're subject to a deemed tax regime, like a special norms or a final tax rate, then you are not supposed to. This will not impact your transfer pricing. You may still have transfer pricing issues. And I think with these provisions of ALP, there are powers, or the guidance is provided to tax officers, that if you have a transaction related to permanent establishment, then the tax officers have the power to. Can you go back? If the tax officers have the power to inquire and require you to provide data related to transactions, all the level up to, let's say, maybe the initiator of the transaction. So, these are very, concerning situations. And I think while actual implementation may still be seen in the coming years on how tax officer interprets it in practice, but these have higher ramifications than what we have seen in the past. So we do anticipate that more clarity comes in this regard on how this will be implemented in practice. Next. So the last is in relation to so the I also wanted to discuss on relation to the PMK 172 you know guidance in relation to financial transactions. It says that if you have financial transactions, then you need to prove that the loan has the nature of a loan. So, like, that the loan is in accordance with the substance and actual circumstances, is needed by the borrower to obtain, maintain, and collect income, meets the relevant characteristics of a loan. It provides economic benefits to the borrower, right? And it says that it should have a maturity date, obligation to repay, and to, and there are payments scheduled for both principal and interest repayment, right? So, and it also, goes on and they'll say that, we may also need to look at what is the treatment done by the lender in their books of account to correlate or consolidate the position, right? That, and, the contract clearly mentions about it. So there are a lot of focus on these transactions. I think because Indonesia also has zero rated loans in practice, and there is a separate PP94 also in this regard. Uh, right? Can you go to that if we have that? We've done an interesting comparison on how this fares to the non-interest bearing loans. So the PMK 172 requires you to meet the substance, the requirement test, that it should maintain the key characteristics of loan and economic benefit. While as PP94 says that the loan is from the shareholders' funds and not from other parties. The capital is supposed to be paid by the shareholder. Now, I mean, while some of these may have, like, maybe point number two, maybe towards substance, but does it meet the complete substance? And whether the shareholder acts as losses, are these tests of substance? The financial difficulty that is faced, because it does not correlate with the facts that how the uh, guidelines in PMK 172 have been framed. Because based on this, it says that if the uh, company is facing financial difficulties on business continuity, because that then it means that it may not economically benefit to the borrower. If there is financial going concern, then I really don't know that how it will be able to meet the substance as a loan. So again, but since these are not revoked, so interestingly, it leaves in a phase that, or a lot of confusion that how it is to be implemented. And often we have seen that in practice, that the tax officers, if the loan is not benchmarked, or if it is zero related, then then the tax officers may not accept a zero rated loan and may want to see that you know what it should be from that perspective. Because if you have, let's say, for example, there are some technical questions that also come, that you have a zero rated loan for a large principal, and let's say based on that, let's say you are close to meeting the thresholds for transfer pricing documentation, but one of your transactions is a large zero rated loan. Now, if you accept it at zero, then if you accept interest at zero, maybe you will not get into the requirements of documentation. But then, if it turns out to be otherwise, then you were supposed to prepare a documentation. So, a lot of administrative hassles on how it needs to be put in place, especially with the clear guidelines coming on that it should meet the substance tests, and likely we should see uh, these zero rated loans may be evaluated in much more detail than they are currently. So we just wanted to leave you with these thoughts that there are some interesting issues coming in, and often tax officers are not very easy going on zero rated loans. Next, some of the recent TP controversies we have faced in this regard is, again, we still find that given the landscape of Indonesia being a predominant contract manufacturer, they often face with capacity utilization issues, and they may require comparability adjustments, not only from a manufacturing side, but maybe from other business parameters. But we continue to see that Many times the tax officers do not pass detailed orders. We give, on to resolve these issues, or understand that there might be capacity constraints which also have impact on the profit margin. So we still believe that this is an area where uh, it requires more elaborate orders on how the tax officer has implemented those comparability issues into the real tax office real orders. And often, the tax orders are not very detailed to give a very clear reflection on what the tax officer thinks on the facts of the given case. So I think hopefully we expect that as more and more regulations and guidance is coming, this should get resolved in coming times. And then also in COVID-19, interestingly, we find that uh, that while the OECD provides that if you are impacted by COVID-19, your industry impacted, then you should make suitable adjustments based on your industry. You may also use outcome-based testing. Let's say even if you are using ex ante basis for your preparation of TP documentation, you may use single year results to support your benchmarking analysis, corroborate analysis with other methods, and various other ways to alleviate the impact of pandemic. But in practice, when we see that since there is no specific guidelines in relation to Indonesia, this is not an easy going discussions. And often, in order to because maybe your budgets might be set during the COVID years, not anticipating the COVID, let's say, in the early part of the COVID, then if those are meeting and then from the budgets, you can explain your actual position, that's a very favorable, argument that the taxpayer can use to defend its transfer pricing policy. But let's say the other way around, if the tax officer does not prepare on taxpayer does not prepare on X anti-analysis and uses ex post, but then they start comparing budget, which is also provided by the OECD, that irrespective of your policy, if you are not able to justify your current results, then you may show empirical evidence on how the COVID impacted you. Then even then, you may still use the budget to give a trail of how you predicted and how it went out and how you coped with the situation, and then what kind of adjustments uh, you know reconcile your actual position. But in practice, the tax officers do not rely on budgets unless it is an ex ante report, which is again, we believe is not consistent with what the COVID-19 guidance has to say. But just wanted to uh, put it in thoughts that while we may still continue to argue, and we believe that this may be resolved at a reasonably. So I think with this, and lastly, I think the tax objections seems to be again might not meeting a very great purpose, because it's just uh, in most cases the order of the tax officers are replicated and no real relief mechanism is coming, and maybe there is a need to review on how this can effectively do more service to the taxpayers and resolve the tax disputes from going to the tax courts. So I think with this, I'll end my webinar here and open to the Q&A if there are. Thank you very much, everyone, for your attention.
Okay. Thank you, Salil, for the very insightful presentation. Now we will continue to the Q&A session. Bapak Ibu sekalian, saya izin memandu dengan bahasa Indonesia juga. Untuk yang ada pertanyaan bisa disampaikan melalui chat box dalam bahasa Inggris ataupun bahasa Indonesia ya. Oke, Salil, there is already questions from the audience. The first one is from Bu Iren. Uh, what are the tax penalties imposed on the taxpayer for not preparing the TP documentations.
I think this is more of a routine, discussion, and I think the guidelines already provide that the disregard. So I think maybe you can refer to the penalties. It's not very high compared to it does not fix it to a transaction value. I think there is a penalty to not maintain the transparent documentation. But I don't know whether this question is as plain as this or
Yeah. Um, okay. So maybe I will also explain in bahasa. Ya,
yeah.
ya. Jadi Bu, mungkin untuk tidak disiapkannya TP doc ini mungkin secara efek langsungnya itu kan memang transfer pricing documentation diwajibkan based on PMK yang terbaru juga masih diwajibkan. Jadi dan waktu pengisian SPT badan itu kita akan mengisi terkait istisar laporan transfer pricing ini dan itu kita akan isi apakah eh, sudah tersedia atau belum dan jika tidak tersedia mungkin akan dianggap SPT kita tidak lengkap itu akan dikenakan sanksi sebesar mungkin 1 juta dan apabila kita tidak menyiapkan TP-Doc posisi kita untuk mempertahankan penjelasan terkait apakah transaksi kita sudah arm's length atau tidak itu tidak ada karena akan diserahkan kembali ke tax authority. Mungkin seperti itu. Oke, Salil. Ya, oke, maybe we next to the next question, Salil.
Yeah.
Ya, from Anne, in the context of effort to profit shifting in digital companies such as the Google case involving the double Irish Dutch sandwich structure,
Mhm.
how can we ensure that the valuation of the movement of intangible assets, particularly digital assets that often lack comparable data or clear market value, is done fairly and in accordance with the arm's length principle? What steps can be taken to enhance confidence in the fairness of intangible assets valuation and reduce the tax potential for tax avoidance in such situations when prepared the TP documentations?
Okay.
Yeah.
So I think there is a guidance in relation to hard to value intangibles because if you are talking about moving the assets from one company to the other, so there is OECD guidance on business restructurings and also specific guidelines on how to value hard to value intangibles. So it again agree with you that maybe the comparable data may be hard to find, and that's where OECD comes up with the view that you may adopt a profit split method. I mean, I'm not advocating clearly without looking at the facts, but if you don't find, the comprehensive data on a full transaction basis, maybe you can use a profit split and look at what are the key intangibles moved and what are the values associated with it in the context of the foreseeable profits and the but again uh, the OECD refers to whether in determining the prices that you refer to the options realistically available. So maybe did you also evaluated other customers for sale of that asset and those kind of things which are sometimes theoretical but that requires some valuation by a certified valuer with appropriate assumptions, which reflects that all the key business metrics have been taken into account to price those intangibles.
Okay, thank you, Sal, for the answers. Maybe since the time is almost 11:30, maybe one more question, Salil,
Yeah.
from Yola. If the taxpayer in Indonesia give loan and deposit their money to the group or a head office which based outside Indonesia's jurisdiction. And for that loan, the taxpayer receive interest payment from the group or head office with certain rate determined by the group or head office. When the taxpayer in Indonesia prepare the transfer pricing documentation, does the taxpayer in Indonesia need to be concerned and disclose this loan transaction in their transfer pricing documentation?
Long question. So if the taxpayer gives loan to head office
Yeah.
outside Indonesia and receives interest, then what
So,
is the next? What is the question?
uh, if the taxpayer in Indonesia uh, give loan,
Yeah. So if the
I
head,
think
the Indonesian entity is giving loan to head
yeah,
office
I think the lender is in Indonesian and the borrower is overseas.
yeah. So
Yeah,
then the question is, do we need to discuss this in the documentation? Of course, because this
yeah,
is a transaction with a special, special influence, and uh, so in often cases, how you put it in documentation. Usually, you have to look at the transaction from whose part it can be tested. More usually, you may look at the borrower country and look at the agreement and try to benchmark the loan from the borrower perspective and you know use that as a basis to benchmark this transaction. This is the most often applied practice, and because it is benchmarkable. But in case but there are non-transfer pricing approaches also, like use of cost of funds approach, where you may have let's say Indonesia is borrowing from another party, another bank, let's say in Indonesia, and then using this money to give loan to the head office. Uh, and then you may use that cost of funds and adjust it to a suitable markup. But again, the other conditions related to, like I mentioned, uh, the substance or the characterization and other things needs to be taken into preview.
yeah. Agree, Salil. So because it's the related party transaction and Indonesian regulation also state that we should document all the transaction if it's already passes the threshold.
Yeah.
So yeah, okay. There are more questions, but I think we already achieved on the last the end of the webinar. I think 11 is already 11:30. So maybe Salil, for your final thoughts and for the closing, please.
Yeah. Thanks again. I think maybe if there are more questions, please write to us and we will reach back to you with the responses. Uh, and I think, as I mentioned, these are again, some of these discussions are, more of eye openers, and we're trying to, understand the implications. That's why we chose those topics, which, especially on the wholesale distributors. I think that uh, depending on the facts and circumstances of your business situation, it may be favorable or unfavorable to you. So that impact assessment has to be done based on, if you are facing uh, tax disputes related to benchmarking or choice of comparable companies, maybe you have an option to look at this if it suits your case. But again, as I mentioned, it may not be a very everything comes with some concerns. So whether it suits your circumstances, maybe you can evaluate. But this is a welcome provision, I assume, for some companies, which may benefit from this and reduce their litigation. Same goes with commodities. Again, it's an rising rising area, uh, primarily because this is very fluctuating. The transactions are very fluctuating and prices are fluctuating, and margins are very thin. So often tax officers test it deeply on what should be the margin, and it becomes a very serious concern whether you know uh, if you implement the government regulations into your transfer pricing policy, it may not help. And you have to appropriately evaluate what is the real transaction and how it should be evaluated, and you should consult professionals on guiding you on this. And same with the again, the use of traditional approaches. So I think as things are becoming more and more wider, it's important to understand the change and be prepared in advance. Thanks again. So I think with these notes, I will end, and thank you all for your participation, uh, and have a good weekend.
Ya, terima kasih Bapak Ibu sekalian.
Terima kasih.
Terima kasih. Untuk pertanyaan yang belum terjawab mungkin bisa disampaikan juga melalui saya dan Salil. Dan juga saya ingatkan sekali lagi untuk mengisi form yang ada di chat box ya, saudara. Terima kasih banyak. Terima kasih Salil, terima kasih.
Thank you. Bye bye.
At RSM, we instill confidence in a world of change. Because when you have confidence, you can act with complete conviction for the future. And in our ever-changing world, with transformation happening at a rapid pace, the depth of insight and understanding we bring matters most. At RSM, we believe the biggest opportunities are found by paying attention to the smallest details, finding difference through understanding, and anticipating the challenges of tomorrow, helping build long-term value today. At the heart of RSM are our people, whose talents, ideas, and energy drive us forward. A collective of 60,000 curious minds, pushing innovation in over 120 countries. Combining local knowledge with global insights, we harness data and real-world experience, building trust that's unmatched and confidence that grows, working together to look further, giving you what you need to take charge of change.